Let's talk a little bit about MACD before we go over and learn how to put it on our charts. Remember, the moving average convergence divergence indicator is referred to as MACD. So very rarely will you hear me say that very long name tonight. Okay. So MACD was developed in the late 1970s by Gerald Appel. Now, all of us know that there was virtually no futures trading on those days. There was stock market trading, but through brokers only, and there was virtually no online trading. Well, the world has changed with the internet and advancement in computers. But the thing about MACD is it works in all markets and is one of the most popular and most broadly used indicators in the Forex market. The basic function of the MACD Forex indicator is to discover new trends and to help identify the end of a current trend. Now, there are various ways to gauge signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, the MACD indicator is typically placed on the bottom of your chart in a separate window beneath the price chart. The moving average convergence divergence tool is a relatively easy tool to use. However, it is crucial to understand it fully before attempting to trade using its signals. Now, this is going to get a little wordy. It may get a little bit boring, but you have to go through it at least one time so that you understand what all the lines are that make up the MACD and where they come from so you can recognize what MACD is trying to tell you. So let me bounce you real quick over to the chart. And here we're looking at the Euro US dollar 60-minute chart. For no other reason, it's just what I use for class. Now, when you drop on the MACD, it is put on the bottom of your charts automatically. So we simply go up to the indicators and locate MACD and click on it, and it will be dropped on the bottom of our charts. But you see, there are two squiggly lines in a histogram or a bar chart. You have to understand where these numbers come from, where these lines come from, to understand what it all is to use MACD properly. So let's start with the basics. Now, MACD is a 4-stage derivative. That means it's 4 levels away from price. So MACD, as the name conveys, moving average convergence divergence, starts out with a moving average, and it uses 2 moving averages, a 12-period moving average and a 26-period moving average. So in other words, we're looking at a 60-minute chart. So it's a 60-minute, 12 60 minutes, or a 26 60-minute periods it's using for its calculations. So I've dropped these 2 moving averages on the chart. Actually, let's change this color so it's a little bit easier for you to see. I made it yellow, but it's horrible to see here. So let's change it over to, let's change it, maybe we'll use dark blue. There we go. So first we start out with a 12-period moving average. What's a 12-period moving average? It takes the last 12 prices from the last 12 periods, adds them together, and divides it by 12. And that gives you an average price. Then we have a 26-period moving average, which is 26 periods going back. Take the close of those 26 periods, divide it by 26, and plot that on your chart. So we have these 2 moving averages on our chart. Now, one is referred to as a slow moving average, and one is referred to as a fast moving average. Okay. Whenever you're using 2 moving averages, the one using the shorter period is considered the faster moving average because it responds faster to the most recent price moves. So in other words, if we're taking a 26-period moving average and going back 26 periods, it's going to only show 126 or reaction to the most current period. Where when we're using a 12-period moving average, we're going to see a lot bigger response in that shorter period because it's only going back 12 periods. So in other words, if gold was trading at $1,200, $1,200, $1,200, $1,200 for the last 11 periods and gold jumped to $1,250, when we would add all that together, the moving average would be at about 1204, 1205. If we were going back 26 periods and gold was at 1200 for all 25 periods and just at 1250 for the 26 period, it would be a minor little move in the moving average. So it would respond much slower. So one is called the faster and one's called the slower. So even if you're using a standard crossover strategy, say a 90 and a 60-day, the 60-day, because it's a smaller period, is considered faster. In this case, we're using a 12 and a 26. Okay. So each one of those numbers is then plotted on the chart, and the moving average is drawn. But this is not part of MACD. This is the beginnings of MACD, because MACD is drawn below the chart. So the first derivative of MACD is the 12-period and the 26-period moving averages. Okay. And then these numbers, like right now, the most current moving average, okay, we can see on the chart is, we can see the most recent moving average right here. So right now, the 26-period moving average is right here at 117.41, and the 12-period moving average at 117.70. We take the 12-period moving average and subtract from it the 26-period moving average, and we plot the difference between those two numbers on the bottom of our chart. And we just take the difference and we plot it on this chart. So we can see down below, underneath our chart, our price chart, we have a zero line. Okay. This line is a positive, it's above zero. So whenever we subtract one from the other and we subtract the 12 period, the 26 period from the 12 period, the difference is plotted on the chart. When the 12 period is higher than the 26 period, it's going to be a positive number. So right now, as we see, it's 12 is 117.70, and we would subtract 117.45 from it, and the difference would then be plotted right here. Okay. And this line, this red line that we put on here, and I've just picked red because I want to use red, is called the MACD line. So the MACD line is the difference between this moving average and this moving average. Okay, it is a 12 period, which is the violet line on here, minus the 26. Now you can see here when the violet, which is the shorter moving average, fell below the longer moving average because we were subtracting a smaller number from a bigger number, the number fell below the 100 because it fell into a minus territory. When the prices crossed over, like right here or right here, when the moving averages crossed over, when you subtract one from the other, what is that number? It would always be zero. So whenever this red line crosses above or below this zero line here, it's telling us that there's a crossover between the two moving averages. Because to subtract, when they are equal, they are zero. When the shorter moving average moves higher than the longer moving average, it would move upward. So it would cross over and up. When the shorter moving average would fall below, it would then cross and come down and be in the negative territory. So once we've got the MACD line, which is this red line, on our chart, we no longer need the 12 period or the 26 period moving average. And that's never placed on a chart because MACD is placed on, the calculation done automatically. And so all we get is the red line. This red line is, like I said, the difference between the 12 period and the 26 period. Whenever it crosses this zero line, actually, let me just put a line on here so you can see it a little bit easier. So whenever it crosses that zero line, we know that the two moving averages crossed over each other. So this is the first line of the MACD. So you know where it comes from, you know how it's explained, you know when it's above zero, the shorter moving average is moving faster and higher than the slower moving average. When it falls below zero, you know the longer term moving average is higher than the shorter moving average, and therefore it's in negative territory, and the difference is plotted on the chart. So you can actually see this in this red line. Now we need to get to the next line, because if we were simply using this to trade MACD, we'd be simply trading a moving average crossover strategy, because all we're getting is when the two different moving averages cross over each other. But MACD goes on one step farther. It adds what we call a trigger or a signal line. This trigger or signal line, and we're going to call it the trigger line tonight, is a 9-period moving average of this MACD line. So it takes the last 9 periods of this number and averages them together and puts that on our chart. So we have our signal line and our MACD line. Our MACD line is the red line only because that's what I chose. And our trigger line or our signal line is the blue line. When the two lines cross over, or the signal or trigger line crosses the MACD line, it gives us transaction signals. Enter and exit or buy and sell signals, whichever you like to call them. It's telling us to make a transaction. It's not analyzing it. Okay. It's not telling you how strong it is, and it's not telling you how far it's going to go in that direction. It just tells you when it crosses over here and it crosses over below, it's telling you to buy. So at this point, it's generating a buy signal. At this crossover, it's generating a buy signal. Okay. Here, right now, we just got another transaction signal. We're just getting the crossover. Well, this is only giving you a bit of information. Now, when these two lines cross over each other, the signal line and the MACD line, what's the difference again? The difference between the two lines would always be a zero. Not on the zero line, but the difference of these two would always be zero. We can plot that on the chart, on the MACD indicator, using what's called a histogram. The histogram is simply a bar chart showing the difference between the MACD line, the red line below, and the blue line, the signal line or the trigger line. So when they cross over, the histogram is always at zero, because when the lines are equal and you subtract them from each other, they are at zero. When the histogram climbs up, when it crosses the zero line and climbs up, it's giving us a buy signal. When it crosses over and under, it's giving us a sell signal. Now, also, the depth of the crossover can also give us overbought and oversold conditions. So first, before we decide we want to trade from this or how we're going to apply it for our trading, we have to understand what all of these lines are. So right now, we have the MACD line, which is the red line, which is the difference of the 12 period and the 26 period EMA, moving average from above, subtracted from each other, and that gives us the red MACD line at the bottom. This being the MACD line. We then take a 9 period moving average of the MACD line, and this gives us the blue signal line or trigger line. We then subtract the MACD line from the signal line and plot that on the histogram. And everything that's happened is actually contained in this histogram. Some of us only trade from the histogram. Other people like, depending on where you like and what you want to do, because you can use different parts of this. MACD gives us 3 different stories. It gives us 3 different pieces of information and can be used 3 different ways. So right now, this is what we see. Before we try to interpret it, what we would see would be this MACD on the bottom of our charts. It would contain the histogram, a signal line, a MACD line, and a signal line. So right now, you should know where we got the mathematical calculations to do this. So once we understand how we derive these lines, we can also then understand when they do weird things, why they're doing weird things, because it all ties back to the chart, and it ties back to the 12 period moving average and the 26 period moving average and then the differences. So we can start telling when the charts and the MACD are out of sync. So let's go back to my PowerPoint. Let's talk about what we would do with these lines now that we have them on our chart. So the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26 period and 12 period exponential moving average, which is EMA. Of the 2 moving averages that make up the MACD, the 12 period moving EMA is obviously the faster one. The MACD generates a bullish signal when it moves above its own 9-day EMA and sends a sell signal when it moves below its 9 period EMA. In other words, when the MACD line moves above or below the trigger line. Now, the MACD histogram is simply an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA or 9-period EMA, and negative when the MACD is below. If prices are rising, the histogram grows larger as the speed of the price momentum accelerates, and contracts as price movements decelerates. The same principle works in reverse as prices are falling. So the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies that we have. Now, the MACD gives us 3 different stories. The MACD proves most effective in wide swinging trading markets. There are 3 popular ways to use the MACD. The one is crossovers, the other is for overbought and oversold conditions, and the last is for divergences. So crossovers are simply like a moving average crossover, but we use a more advanced crossover because we're using a crossover from the signal line and the trigger line. So here we have the MACD line in black down below and the signal line in red. And we can see when they cross, they generate, in this case, when they cross and moving down, they give us a sell signal. When they cross and the MACD line moves over, it's giving us a buy signal. Here a sell signal, here a buy signal, here a sell signal, here another buy, and here another sell. Now, the one thing you have to understand and realize is the MACD generates a lot of transaction signals, but it doesn't tell you how far up or how far down that asset is going to come. So it's just simply telling you, it's giving you a buy signal or a sell signal. You have to use other types of indicators to decide whether it's a signal that the price is going to move enough to make it worth for you to enter the markets. So the basic MACD trading rule is to sell when the MACD line falls below its signal line. Similarly, a buy signal occurs when the moving average convergence and divergence rises above its signal line. It is also popular to buy and sell when MACD goes above and below zero. So remember, we had the zero line on the charts. When MACD alone falls below zero, it can give you a sell signal. When it climbs above the zero, it can give you a buy signal. Now, I just want to get these markings off the chart here. Sorry about that. Okay. Now, MACD is also useful as an overbought, oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, MACD rises, it is likely that the symbol is overextending and will soon return to more realistic levels. So when the MACD rises significantly higher, the MACD line, it's telling us that the market can be oversold. So these peaks and valleys will help us. When the MACD line falls significantly, it can tell us the market is oversold. And then lastly, we have divergence. And divergence with crossovers give us a very, very good trading signal. So an indication that the end of a current trend may occur was when the MACD diverges from its symbol. So in other words, when we see price in a downtrend, in other words, making lower lows and higher lows and then lower lows, or in other words, price is moving down, and we see the MACD line making higher lows. So in other words, the MACD line is actually moving in a slight uptrend when the actual price is moving in a downtrend. So what we have there is bullish divergence because the MACD line is moving higher where the price is moving lower, so they're diverging from each other. When we get the signal line crossover, then after that, when it occurs right after a divergence, it is a very, very positive signal. So we get the breakout here at the same time we get the signal, and that's telling us to buy into that marketplace. We could get the opposite and get bearish divergence, and that would be a sell indicator. So a bullish divergence occurs when the MACD indicator is making new highs while price fails to reach new highs. A bearish divergence occurs when the MACD is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold indicators. So in other words, we're using three pieces of information. We're using the crossover, we're using the very large peaks and valleys, and we're using the divergence. So a bearish divergence forms when a security records a higher high and the MACD line forms a lower high. The higher high in a security is normal for an uptrend. So in other words, when price is moving up, we should always be making higher highs. But the indicator, the MACD line here, is making lower highs. So we see the MACD line is moving in a slight downward movement, downtrend, while price is moving in a slight uptrend. So what happens is they're diverging from each other. Even though upside momentum may be less, upside momentum is still outpacing downside momentum as long as the MACD is positive. Waning upward momentum can sometimes foreshadow a trend reversal or a sizable decline. So remember, we're dealing with a 4-stage divergence, and we use this to finalize it in the MACD histogram. Now, the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. So how do we get there? First, the first derivative is the 12-period EMA and the 26-period EMA. Remember the 2 lines we plotted on the chart. The second derivative is the 12-period EMA minus the 26-period EMA, which forms the MACD line down below, which was our red line. The third derivative is the MACD signal line, which is the 9-period EMA of the MACD line, the blue line we placed down below. And then the fourth derivative is the MACD histogram, which is the MACD less the MACD signal line. The base of the indicator, though, is always the price. And it takes 4 steps to get the actual price to the histogram. So we talk about massaging data. Well, not necessarily a bad thing. Charters should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So as with MACD, the MACD histogram is also designed to identify convergences, divergences, and crossover. But we simply do that in the peaks and the valleys of the histogram. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when MACD is above its signal line. Positive values increase as the MACD diverges farther from its signal. The positive values decrease as MACD and its signal line converge. But what everybody always wants to know is transaction signals. Everybody wants to use MACD for buy and sell signals because they're fairly reliable, but they are alerts. They aren't telling you to actually enter the market because you have to first calculate using other indicators whether that movement is going to be large enough for you to make or trade it. So it has become standard to plot a separate moving average alongside the MACD, which we talked about. It's a signal line or the trigger line. A signal line, also known as a trigger, is created by taking a 9-period moving average of the MACD. This is found plotted alongside the indicator on the chart. As you can see, transaction signals are generated when the MACD line crosses through the signal line. The basic bullish signal buy sign occurs when the MACD line crosses above the signal line. So when we looked at it on our charts, the MACD line was what we had in red, and we put our MACD signal line in the blue. So in other words, when the red line crosses above the blue line, the basic bearish signal is generated when the blue line crosses the red line. Traders who attempt to profit from bullish MACD crosses that occur when the indicator is below 0 should be wary that they are attempting to profit from a change in momentum direction. While the moving averages are still suggesting that the security could experience a short-term sell-off. So it's important to also, at every time you get one of these signals, is realize where the signal and the MACD line and the crossover are in relationship to that 0 line that I showed you, or called the center line. So as mentioned earlier, the MACD indicator is calculated by taking the difference between a short-term moving average and a longer term. Given this construction, the value of the MACD indicator must be equal to 0 each time the 2 moving averages cross over each other. A cross through the 0 line is a very simple method that can be used to identify the direction of the trend and the key points when momentum is building. The various signals generated by the indicator are easily interpreted and can be quickly incorporated into any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure short-term direction is working in their favor. Now, as I mentioned earlier, the drawback or the biggest disadvantage of using the indicator-generated transaction signals is that a trader can get whipsawed in and out of position several times before being able to capture a strong change in momentum. So as you can see in this chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move, and that can cause the trader to realize several unimpressive gains or even some small losses during the rally. Traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements could cause the indicator to change direction quickly. The large number of false signals can result in the trader taking many losses. So make sure you combine this with other indicators to determine whether the trade signal is worth trading. So the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crosses over the signal line make it easy for traders to ensure they are trading in the direction of momentum. Very few indicators in technical analysis have proved to be more reliable than MACD. And this relatively simple indicator can be quickly incorporated into any short-term trading strategy. So remember, momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when that ball will stop climbing and change direction and descend. Just like physics, momentum changes occur before the price of an asset changes. And MACD can give us these pre-warnings. The strength of the current trend can be measured by channeling the MACD, spot trend reversals by looking for divergence in momentum, and determine buy and sell signals for using crossover and bounces. So like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea, divergence. Applying this method to the Forex market, which allows effortless scaling up of positions, makes this idea even more intriguing for day traders and position traders alike. So MACD is fairly simple to add onto your charts, fairly easy to learn and master once you understand where all those lines come from. So the whole idea with MACD is get it on your charts, drop the indicator on, start watching how it moves. Don't trade it. Watch for the crossovers. Watch, see how the signal line and the MACD line work. Start practicing with the histogram and get your eye used to it. See if you can take the MACD line and the MACD signal line completely off your indicator and see if you can watch the price move by watching the histogram. Once you can see all of that price movement and see the relation between the histogram and the price on the charts above, you'll be ready to start trading with MACD. So thank you very much for joining us tonight. Thank you for supporting Trade Time, and we'll talk to you again real soon. Have a good evening now. Good night.